Welcome to Breaking News to Trading Moves. Today we're looking at a pretty interesting announcement from a major premium automotive brand and what that might signal for a few different sectors.
Yeah, the focus is really on the high-end EV market, Porsche specifically. They're delaying some key electric vehicle launches and, well, they've had to adjust their financial forecast pretty significantly.
Okay, so it's not just pushing back a date on a calendar. There are real financial numbers attached to this.
Absolutely. This isn't minor for anyone tracking EV adoption or just profitability in the auto industry or even energy. This news is a data point you have to consider.
Let's start there then, the financial side. How big of an adjustment are we talking about? What did Porsche actually say about their numbers?
Well, this is where you really see the impact. They've cut their margin target for 2025, and not by a little. The new target could be as low as just 2%.
Wow, 2%. For Porsche, that sounds really low compared to what you'd normally expect from a luxury brand like them.
It is startlingly low. It signals some serious pressure they're facing.
What does that kind of margin drop really mean, especially, when you think about how much it costs to develop these new EV platforms? Those costs are huge.
Exactly. It points to a big disconnect between those massive fixed costs, the R&D, the factory tooling, billions up front, and what they now expect in sales volume, at least in the near term.
So delaying models like the electric Macan, that pushes back the revenue they need to cover those costs.
Precisely. And a 2% margin suggests that, for now, the money coming in is barely covering the ongoing costs. It's definitely not generating the kind of profits investors usually associate with Porsche.
Okay, so why the delay? Why tap the brakes now? What reasons did they actually give?
It sounds like it's not just one thing. It points to broader issues, not just some internal hiccup. They mentioned three main factors.
Go.
First, just softer demand overall for premium EVs. Globally, maybe consumer appetite isn't as bottomless as hoped.
Okay, chapter 1.
Second, they specifically called out weakness in the China market. And China is, absolutely critical for luxury car sales.
Right, a huge market for them. And the third?
Rising operational costs. Think inflation, supply chain issues, maybe linked to geopolitics. It's getting more expensive to build these things.
So softer demand, trouble in China, and higher costs. That's a tough mix, especially for the luxury end.
It is. And if a leader like Porsche is feeling it, that definitely changes the picture for others in that premium EV space.
Let's talk about that change picture. If Porsche is being cautious, where does that create maybe some unexpected advantages?
Yeah.
Or tailwinds? We see some potential benefits for automakers still big in traditional engines, ICE, and hybrids.
That's exactly right. Strategically, if a major premium EV competitor slows down its rollout, it basically extends the lifespan of high profitability for internal combustion engine trucks and SUVs.
Those cash cows.
The cash cows, exactly. For the established players, it gives them more time where those vehicles are really driving profits. And it might cool down the EV price wars a bit too, which have been costly.
Okay, so who are the specific automakers that might benefit here?
Well, first one that comes to mind is Ford. Ticker is $5. Ford's position looks pretty solid because they have that very profitable mix of pickups and SUVs.
Like the F-150?
Exactly, the F-150, even the Maverick. And they're seeing good hybrid uptake on those too. So with Porsche easing off the accelerator in premium EVs, Ford might feel less immediate pressure to slash prices or rush their own next-gen EVs out before they're ready. They can focus on maximizing the profit from what's selling well now.
But isn't that just kicking the can down the road?
Yeah.
Relying on ICE profits for longer? Does that set them up for problems later when the transition does pick up speed?
That's the key question, isn't it? It's more of a tactical win than a long-term strategic solution. It buys them time.
Time for what?
Time to use that current cash flow to fund the development of better, maybe more profitable EVs down the line. Time to get it right without needing tons of expensive outside funding. So yeah, it's less about winning the EV race today and more about protecting their current business while they prepare for the future.
Does that same logic apply to General Motors?
Right.
GM?
Yes, very similar situation for GM. Ticker GMM. Their profits are also heavily reliant on those higher margin full-size trucks and SUVs.
Sierras, Silverados, the big SUVs.
Correct. So sustained demand there lets GM be maybe a bit more measured, more controlled in how they roll out their own EVs and hybrids. They can potentially avoid some costly early missteps, protect those current margins.
Okay, so the automakers with strong ICE portfolios get some breathing room. If the EV transition slows, even at the premium end, that must have knock-on effects for energy, right? Oil and gas producers.
It's a direct link. If the assumption of really rapid EV adoption, especially premium adoption, gets dialed back, well, then the expected decline in demand for gasoline and diesel gets pushed further out.
Meaning demand stays stronger for longer than maybe some forecasts predicted.
Exactly. And that supports cash flows for energy companies, particularly the upstream producers who rely on that steady demand for liquids.
The material we looked at mentioned Exxon Mobil, Sexolum specifically.
Yeah, Exxon is a good example. Because they have that integrated model, meaning they're involved all the way from drilling crude oil to refining it and selling the final product.
Right, the whole chain.
So if people keep driving gasoline cars for longer than expected, that helps stabilize demand and margins across their entire business. It provides a longer period of that predictable revenue.
Okay, we've covered the potential winners or beneficiaries. Now let's flip it. When a brand like Porsche signals caution, where does the negative impact land most heavily?
It tends to hit the pure-play EV companies hardest, the ones only making electric vehicles.
Why them specifically?
While the optics aren't great, if a luxury leader is seeing headwinds, it can make potential customers for other premium EVs hesitate. It can erode pricing power harder to command top dollar, and maybe most importantly, it could make investors a bit more cautious, potentially raising the cost of future funding they need to grow.
Makes sense. So which companies are most exposed right now?
Rivian comes to mind immediately. Ticker Rivian. Their whole current lineup, the truck and SUV, sits squarely in that premium segment where Porsche is seeing softness.
So tougher demand outlook for them.
Definitely. And that comes at a time when they're still trying to scale up production efficiently. It puts pressure on their average selling prices just when they really need strong margins to get towards profitability.
What about a company like Lucid, LCID?
Lucid, ticker LCID, faces a kind of double whammy. They have to navigate that same softness in the luxury EV market, but they're also dealing with the broader economic climate of higher interest rates.
And higher rates make borrowing money more expensive.
Exactly. Money they need for factories, for scaling up, so you've got potentially hesitant buyers in their target market, and it costs more to fund the growth needed to reach profitability. It just makes that path significantly steeper, much tougher than maybe it looked just, say, 6 months or a year ago.
Okay, that connection is clear. Let's move further up the supply chain now. Battery materials. Why would a company like Albemarle feel this Porsche news almost immediately? They don't sell cars.
It's a very direct, almost mathematical link. If you forecast fewer premium EVs being built in the near term...
Fewer batteries needed.
Exactly. Fewer batteries means less demand growth for the materials in those batteries, like lithium. And the pricing for commodities like lithium is incredibly sensitive to expected demand.
So if future demand expectations flatten out, even a bit,
it puts downward pressure on pricing momentum for the material producers right away.
And Albemarle, ticker ALB, is a major lithium producer, so they're particularly exposed here.
Correct. ALB is very sensitive to lithium price expectations, and those expectations are fundamentally tied to how fast everyone thinks EVs are going to be adopted globally. A signal of a slowdown, especially from a premium trendsetter like Porsche, directly impacts how the market views future lithium demand and therefore its price.
So summing this up then, one company, Porsche, adjusting its EV plans seems to create this divergence, a sort of tactical advantage for established automakers with strong ICE and hybrid sales.
Giving them a bit more time.
Right. And on the other side, increased pressure on the pure-play EV companies and also the battery material suppliers who are banking on really rapid, uninterrupted EV growth.
Yeah, and what's really striking here is that this caution is coming from the high end of the market, the segment you'd maybe think is most insulated from economic bumps.
The part that was supposed to lead the charge.
Exactly. It was seen as paving the way for the mass market. This news suggests maybe even those high-income buyers are being a bit more careful, more scrutinizing than previously assumed.
It leaves you with a question, doesn't it?
Mm-hmm.
As you process this, think about this. If the most visible premium end of the EV market is showing signs of slowing down, what might that imply about the timelines for a broader mass market transition, especially for lower margin vehicles?
It's definitely something to consider. How dependent is the whole transition speed on that premium segment pulling it forward?
Okay, before we wrap up, just a reminder. Please remember that the information discussed today, including those references to ticker symbols $5, DGM, Sexdolarems, Kreven, Wuval LCID, and Willem Bays, is purely the opinion of the author. It's based on the material we reviewed.
And very importantly, this is not financial advice. It's not a recommendation to buy or sell any security. Always do your own research.